Good afternoon, everyone. James Hicks here from Hicks New Media and Infotainment News. Sunday afternoon. What better day than to talk about more money, more finance? I know we've been doing a lot of that with some of the series that we have on the platform, and we might as well continue that whole conversation because it's timely, it's relevant, it's news of the day. Today, I am joined by a very good friend of mine, a man who is in the financial industry, man who is in the mortgage side of the financial industry. So today, we really are going to talk with you and just have a dialogue back and forth about opportunities, trends, fluctuations, and things you can do while managing your financial mortgage life during the pandemic. So without further ado, ladies and gentlemen, Mr. Chris Harris. Chris, how you doing today, brother?
I'm well, brother. Thank you for having me on.
Definitely, man. Appreciate you taking the time to join us today. And kind of like I said in the intro, like I've been doing a lot of talking lately about money, about finance, about investment, and I think this was a good culmination about from a mortgage perspective, and primarily a mortgage perspective during these crazy times that we're in now during the pandemic, right? You
Definitely
know,
relevant.
yeah. I mean, so that being said, are you seeing anything specific your particular industry now as opposed to 4 or 5 months ago, as it comes to mortgage lending and things of that nature?
Well, I think since COVID really came to the forefront, uh, the lenders weren't sure what to do. Everybody was kind of flying their mortgage and rental pay history, and the government put moratoriums on what efforts lenders and landlords would back up to the people behind the guidelines that the lenders and brokers follow.
Mm-hmm.
Fannie Mae, Freddie Mac, VA, and FHA mostly. And at first it seemed like the lenders were all just kind of pumping their brakes on. Started with appraisals, I would say, was kind of the first one that you really, appraisers usually need to go into the house, take a look around,
Yeah.
take some measurements, assess the condition. And that was one of the first things that really shook things up was, what do we do there? And we had to wait for some guidance from the investors to let us know how to proceed in that space. But I think the lenders in general knew things weren't going to have the greatest outlook. I don't think it was possible for things to be back to where, considering how many people were losing their jobs. Was it March, April, when it was just every day a few more million people were signing up for unemployment? And keeping that in mind, and people were worried about the economy, right? Some of that worry led to, we saw some big fluctuations in the stock market.
Yes.
February, March, April, May. And a lot of that led to a significant drop in rates. They have never been lower. But I would say too many because the lenders couldn't handle it. The amount of volume that was coming towards the lenders in February and March was kind of was a cascading effect, if you will. You got a bunch of people want to refinance. Appraisers aren't wanting to go into the homes for obvious reasons, to protect themselves. And it became interesting. It was a new dynamic for everybody.
Okay. Now, I know I got caught up in the middle of that. Look, I was going through a refinance opportunity during that, and I remember the appraiser drove by the house, took a couple of pictures outside. He didn't walk up to the house. I was like, all right, if that's how it goes, he just took the Google Maps pictures, I guess, of the neighborhood and says this house is okay. We're gonna sign, seal, and deliver it. So, do you think any of the operations from this new world order, right? So I hate calling it the new normal, but just the way that we're operating now. Do you think that some of these practices within your particular industry are going to remain as we eventually do come out of this, and when we do have a vaccine and we can stop walking around with masks on and things of that nature? Do you think some of the practices that your industry has developed during these last 4 months will remain?
I think so. The prevalence of the investors granting what are called appraisal waivers, you know, where literally as long as the individual or the applicant's credit and budgeting and asset structure was adequate, and the estimated home value was there, for them to say we're good. We don't actually, we believe whatever value you put is fine. I think a lot of that's going to stick, partly because it's perceived that rates are going to stay low for a while, and they should actually be lower than they are. Part of the concern and the I guess the uniqueness of this specific trend, downward trend in rates, is economic indicators suggest rates should be lower. I think if you're looking to buy a home, those rates are generally lower than a refinance rate, and those purchase rates are a lot closer to where the economic indicators suggest rates should be in general. But with the appraisal waivers, a lot of that's going to stick, partly because it's just expected there's going to be a high volume. I've read something in March about almost $11 trillion worth of loan volume in the United States that could benefit from a refinance now. But the lenders, the total capacity across the nation for all lenders is only about 3.1 trillion. So you've got a backlog of 3 years worth of loan churn that's going to take place. And that high volume is, we can see those appraisal waivers sticking around for a while to help speed that process up.
Gotcha.
Part of why rates aren't lower is because lenders can only handle so much. And one of the things I frequently get are when people are debating whether to do a refinance or what are rates doing in the near future. And it's hard to say. We hope they continue down, but if the lender can't handle it, it does them no good. I mean, at the end of February, at one point, we were the lenders were so maxed out that some of them were saying, sorry, we can't take an application right now. An application, but we can't lock you in because we don't know how soon we can get you through the pipeline. Yeah. And that's different. That's different. And I don't know. There's going to be, I would say, if somebody was considering it, it's generally just do it now while it's here, because we don't know what might happen week.
Yeah. And you never do, right? I want to step back, and I know I don't want to gloss over, and I think a majority of folks understand what you say when you say rates, but again, which rate are we particularly talking about, right? We're always looking at, look, I got CNBC on this TV all day, every day for the most part, right? So I'm watching the financial markets, I'm watching my stocks and my investments, but which particular Fed rate are you looking at that is most prevalent to you and your industry?
Historically, mortgage interest rates would correlate to, not exactly, the 10-year Treasury yield, government bonds. Generally, if there's a little economic uncertainty out there, people would tend to move their money away from securities like stocks and mutual funds and move them into safer securities like your government treasuries. And when there's a high demand for those, the government can charge a lower yield. And that lower yield tended to bring down mortgage rates, or as the yield fell, mortgage rates tend to fall, whether it was a 30-year fixed rate, across the spectrum of all, shorter term loans, longer term loans, fixed rate adjustables. And the yield has never been this low. And that's part of where, if you look at mortgage rates, where people will say 1.5%, and where rates are when the yield's sitting at 0.7%, it's literally half but the rates haven't fallen in line. And that's the historically that I would tell my clients to pay attention to. Those who are on the fence and maybe wanted to wait a little bit longer, I say, well, if the Treasury falls to around this level, if I haven't already reached out to you, shoot me a text, give me a call, because that might be the time to move forward on that desired interest rate with that desired cost structure. But it's hard to do that now because the rates are more driven by the capacity of the lender. As I was mentioning a bit ago, if some folks like to talk about that low interest rate at the dinner table. For some reason, 2.99% sounds better than 3%, right? Saying what we're pumping. And, that dinner conversation, I went to ABC Lender and got that 2.99% rate, but it took 4.5 months to get it done. And I can't stand the mortgage guy anymore because he stopped following up with me like he used to. Mm-hmm. And so lenders don't want that bad customer service. They want to retain that business, especially the lender I work for. That's our bread and butter is driving new customers and opening up the number of products they have with my bank through the mortgage channel. And so it made more sense to artificially keep the rates a little higher to slow down the influx of applications to keep it manageable while we, hire and bring on more and retrain others to help support, getting those people through the pipeline. But that's the indicator generally, is the 10-year Treasury yield.
Okay. And is that the same irregardless of a new finance or refinance opportunity?
Yeah, they both follow the same. Generally, a refinance transaction will have slightly higher rates than a purchase transaction. And I think part of that is because on the purchase side, it's a new client acquisition. So it's a new opportunity. I guess more profit is perceived to be possible to earn over the long term with that client from the lender. Got you.
Now, I guess, so in terms of, let me think about this. Inventory, right? And the actual, the supply and demand curve. What are you seeing? Are you seeing more folks trying to move into some brand new developments, or are you seeing some resale opportunities out there? Has anything changed again within the last 4 months, or?
No, it's been really bizarre. There's a lot of people who I'll run into that are like, they know intrinsically the economy is not as good as what it seems to appear on television. People know somebody who's out of work. They know somebody who's selling the nicer vehicles to just downsize, partly because they're not commuting anymore, and why make the payment? But there's still quite a few people buying, and the supply that's out there is the supply from those who are choosing to sell their home, or there's a lot of builders still building, and they're not staying on the market generally too long unless the real estate professional wasn't perhaps a little too aggressive or priced a little higher than what the market would bear. But the clients that I'm seeing are typically getting in a contract relatively quick. There's multiple offers still. You typically want to jump in there with your highest and best offer if you really like the place, because it's probably not going to be on the market very long.
Yeah, I remember, I don't know what it was. Was it 10 years? So you're in Northern California as well. You're right here down the road from me, Sacramento, Roseville area. And look, was it 10, 15 years ago when there were literally folks camped out at new housing developments, right? In lawn chairs with not just high bids, but with cash in hand. Right. So it was a lot of influx from the San Francisco Bay Area, a lot of that internet money, right? Moving to the suburbs and moving outside. And I doubt we'll see that again for a while, because one thing that you mentioned, I think that is incredibly relevant. The way the economy is now is not really what we're seeing in the media, right? There are folks, and we all know that degree of separation. We know, if it's not us, right, we know someone close to us, around us, who has been affected by these times of turmoil. Someone is out of work. Someone has lost a lot of hours, or whatever the case may be. The economy is not as robust as it may seem on whatever channel that you're particularly looking at. So that's important and that's relevant. Let me bring that back and ask you, from your industry perspective, is your industry doing anything different because of that? I mean, are there different programs that are being offered to folks who may have a great credit score, may have some decent longevity from their industry, even though they're either in a lull right now, but longer term financing, lower interest rate. I mean, you know what I mean? Are there things that you're offering now, for just your industry, not just your organization,
Um,
to assist?
I think in the mortgage space, you work in this industry long enough, you have folks who are your coach who are now technically your competition. I have a lot of good friends that are at other banks, and we're still friends. So we talk, we share
Mm-hmm.
what's going on behind the scenes with each other's institutions. What are the guidelines like? What's underwriting turn times? Just what's happening out there? What programs are you doing? What can I not? Maybe I can send business your way and vice versa. And one of the unique things that we saw with this market, somewhat similar to 2006, 7, and 8 when it crashed, was a retraction in guidelines. You know,
Hmm.
somebody who wants to get a what's called a jumbo or non-conforming loan, a larger loan, up until February, March, could finance 89.99% of that and only put 10% down as long as they had decent credit and some cash reserves. Lenders started scaling that back, 80%, 75%, increasing the number of months that's actually required. Mortgage payments in the bank as a safety net have become part of the conversation in the temporary guidelines for a lot of these lenders. There's not the only thing that's really happening that I've noticed that is protecting consumer, because it's really protecting the institution who's lending the money. They want to make sure the person they're giving a loan to can make the payment on time for a number of reasons.
That's true. That's true. Yeah.
As a generally a big bank lender, when our name's on the paperwork, if it's a what's called a Fannie Mae or Freddie Mac loan, meaning it's generally under a certain dollar amount, those are, as a lender, we're just getting a monthly payment from the investor, Fannie and Freddie, to keep our name on it and handle the day-to-day customer service type functions. And we want to continue to get that revenue stream. Otherwise, now we're in more trouble.
Right. Right.
I would say broadly on the bank level, there's things I've heard that we're doing when it comes to, waiving fees on this, not hitting people for penalties on for missed payments. That if somebody wants to get a mortgage right now and maybe they had to take advantage of that forbearance opportunity that the lenders, for the most part across the board, offered, you can just defer when you make your mortgage payment for 3, sometimes up to 6 months. Those moratoriums from the government, from my understanding, prevented lenders from negatively impacting their credit score with that. They weren't allowed to report that as a negative thing on their credit report. Okay. And so internally, if somebody is a current client of the bank I work with and they would like to get a mortgage, and when we do some research, we found out that they are actively in the forbearance process, we cannot actually offer them a loan. But once they're done with that, yeah. So if they have options, though, we give them the grace to catch up. So if they entered into a 3-month program and they're 2 months in, but they really did it, and a lot of folks did this, they only did it to stockpile cash because they had certainty what's happening. I mean, honestly, if it's not going to report negative on your credit report, and you can choose to pay it back when you want. I mean, someone who's tackling a $3,000 a month mortgage, that's $9,000 in the bank by summertime.
That's true. That's real. That's real money too. Yeah, right.
That is real money. And if the only negative impact is that the interest for those payments went to the back of your loan, a lot of folks took advantage of it. So what we're doing is we give them a choice. We say, okay, well, you can exit the forbearance process, but you got to get caught up first. So if you're 2 months in, get those 2 payments made, get caught up, officially exit the program, get us paperwork to show that's happened. And now we can verify that you've got 3 months of on-time payments, which is the real big thing we're doing. Somebody who's, regardless, it's standard procedure right now that we want to get not just the most recent month's bank statement. We want mortgage statement. We want the most previous 3 months mortgage statements. We want to see that That's what the credit report says. Show us that you
Gotcha.
made these payments on time for the preceding 3 months, and we're a green light. We're fine
Okay.
to move forward
So,
as long as all,
all right. So there is, I guess, some of those additional requirements, which is fine, which makes sense, right? Your organization's you are a for-profit organization. You're not a non-profit organization, so you're in business to make money. But I think couple of things that you mentioned, I don't want to gloss over, and I want to make sure that folks don't assume that they know. Again, yeah, if you go into that deference, that really is, it's not forgiveness. It is deferred. It comes back to you at the end of your loan. You're not just saying, I don't want to pay these next 3 months of my mortgage. You don't have to pay them now, but you will pay them down the road at the end of that 15, 20, or 30-year mortgage. So if that
Yep.
$2,000, $3,000 per month doesn't go away. That's one thing. And then you mentioned classifications of loans again. I want to make sure that we're not missing over some terminology. You talked about a jumbo loan, and so
Sure.
here in California, can you explain the difference between the Freddie, the Fannie? It's not Sally here, but
Right.
all the Fannie Mae's, but what constitutes a jumbo loan?
It's every county is different. It's actually county specific. Now, a lot of the counties in a given area are going to be very similar or the same. Trying to think of what it is now at Sacramento. I think it's 551, 400, right about there. I can get the exact number, but if the loan exceeds that, it has to be jumbo.
Okay.
It has to be a jumbo loan. Now, a jumbo loan is different because the bank's lending their own money at that point. It's not money that's sort of fronted and then reimbursed behind the scenes between the lender and if it's below that mark, it's going to go to Fannie Mae or Freddie Mac. We send it out to them.
Okay.
We put the money out to close the deal. They reimburse us on the back end.
Mm-hmm.
But again, we're only servicing it. Just we're getting a monthly servicing fee to handle the day-to-day stuff. If it's a jumbo loan, we're the servicer and the investor. We're earning revenue on the rate. We're earning revenue on the servicing. And though because it's the bank's money, there's some more flexibility there. There's a little bit of playing favorites that can sort of happen. You can get additional discounts on the rate depending on the financial relationship you have with the institution.
Mm-hmm.
But every county is different. You go into higher value, dollar value, home value areas, the Greater Bay Area, your San Carlos, your San Francisco. Those have higher thresholds, 800 and something. Off the top of my head, I don't know.
But again, you think about cost of living, right? I mean, so yeah, that number is inflated, but that whole cost of living, what you're actually bringing home is not the same because it costs so much just to eat dinner there, have the lights on. It's a little different. You can get for what you can get for 400,000 here, you can get 1-bedroom flat in the Bay Area proper, which is I will still never understand that, to be honest with you. You mentioned something as well, and I've fallen into this a couple of times, and I want to hear it from you. Your organization, your company has sold my loan a number of times, and I took that. I was a little upset at first. But then when you explained it to me, it did. I understood that it wasn't. James Hicks, we won't like you anymore. We're going to sell your loan off to another organization. But explain why that happens from large scale lenders a lot of times.
That's a very good question. There's two parts, and I still get this frequently. Clients would be signing paperwork. Chris, are you going to sell my loan? It happens for a number of reasons. So if you're not working directly with a bank, and you're working with a mortgage broker, you have to go in understanding it's going to normally get sold because the broker is just there to facilitate the transaction and then take a profit for getting that deal. They will then package that. They send it to whichever lender they structured it to go to, whether it's the lender going to pay them more to give the loan to them or whether that particular lender has a little more lenient of a guideline that help them get the deal done more easily. that loan's going to get sold from the broker to a lender or just to another servicer, and that servicer may turn around and decide to sell it again. And it's all about their decision normally to just take an upfront one-time profit and move on to the next one. Very transactional. When you get to the big bank level, like what you and I had worked with, the decisions are more, sometimes it has to do with what the credit risk class of the loan. Were they paying on time? Were they doing this? Were they doing that? And that wasn't your guys' situation at all. A lot of folks feel that's what happens to them. It's like, oh, I missed one payment, sudden, you're selling my loan to somebody. And that does happen. Somebody's habitually late on something, then on the mortgage. I've seen it, where there's a couple different servicers that all of a sudden those loans just went to, because maybe now it's considered a higher risk loan. But in your case, it had to do with that, and it acquired too many of them. Because they have to maintain what they call a balanced portfolio, and every so often, whether it's every couple years or every few months, they have to evaluate how much of each type of loan do they have. And if they're they have too much of one type, then the bean counters decide, well, we need to pare down how much we have of that type of loan, and that's the space you and I fell in.
Okay. So I won't hold it to heart anymore. I'll cut you a little slack. I was talking bad about you and your organization. I was like, I'm not investing in this company anymore. And where I come back. I tell you what. So I'm gonna do a little something. I'm gonna do a little something different here. I'm gonna throw you a curve, which I think I'm gonna start doing. I'm a technology focused guy. I want to ask you, kind of staying in line with the discussion, is there any piece of technology that you're utilizing to manage your business, right? I mean, yeah, you've got the tools that you're provided inside of your organization, but what are you using to manage your day-to-day business, either from a productivity perspective, from tracking of time and resources and contacts, whatever the case may be? Is there maybe what's on the front screen of your mobile device? What type of technology that you get you to today?
It's the mobile device and my company issued laptop.
Right.
We one of the things I like about where I work is how much we have available to us. We have a great customer retention program. Anybody who I send even just quotes to become part of that program, and we have a drip system that sends out periodic correspondence to them. We're utilizing Outlook all the time for just managing our day-to-day stuff, but
right.
There's always stuff coming at me to help, just alert this, check that, get on that. I'm not doing anything particularly special. I utilize my website. I utilize.
You're taking advantage of what's you're taking advantage of what's in front of you. I love it. Yeah, and folks,
you get my letters in the mail.
I do, and you know what? I don't mind getting your letters in the mail because they don't come like every week. They come when they need to come. If I've got a question or if I've got an issue, I can either opt out or what, but I can come right to the source. So I do appreciate your progressive marketing because it's relevant as well, right? You're not just sending things that aren't relevant to my needs. You're not sending me farm land that's for sale when I live completely away from any of that.
I've seen that happen when the realtors, once you close the deal with them, then you stay on that drip for the next purchase. On technology though, specific to mortgage, it's really important right now for somebody who wants to buy a home or refinance a home. There's a lot of folks in the baby boomer age who are still a little shy of technology. And there's still the ability for lenders and brokers to accommodate those folks with some semi face-to-face type of interactions and transactions at the bank and other places. But right now, being able to utilize the online tools are huge. These days, completing your mortgage application online, uploading documents right through the application, what used to take a couple 3 days just to get in front of an underwriter processor can be a same day situation now. You can complete the application, you can download all your bank and mortgage W-2, you can get it in the system, you can sign electronically your disclosures, and by the following morning, we're 85% done with your loan. Now it's just getting it in front of the processor and underwriter to check boxes, cross T's and dot I's, and be done with it.
Yeah.
And that's critical because of how busy everyone is. I mean, if you want your loan to get through faster, utilize technology.
Definitely, lock in those rates, utilize that technology, and I can speak from my experience as well, right? Just being able to DocuSign online and having the workflow, right, that came from your organization, keeping us on task with everything that needed to be done, incredibly timely, incredibly informative, and literally, we got the notary here at our house for our particular situation. I think he was off at 5 o'clock. We got him here at 4:50 that evening. We signed the 800 pieces of paper that needed to be signed, and next thing you know, that evening I'm getting emails from you and from everyone saying we're all done, we're all squared away. Boom, we have successfully refinanced your mortgage. So I'm a proponent of that for sure. One thing that I will do in the show notes and on the posts I put on Infotainment News is I'll put your Safe ID number, and sure, I will put a link to your website as well and your contact information, just in case folks who wanted to dialogue and wanted to interact may have some questions again about managing through not just during the pandemic, but just mortgage situations in general. So financing, refinancing, and whatever the case may be.
Anytime. I mean, folks, I can't help everyone, but there's no charge to just get a review of your mortgage. Sometimes there's strategies folks haven't thought of or heard of that I can assist with, whether it's working with me or someone else. I'm not able to assist everybody, just perhaps I don't have the product that they need. One of the things that's changed, we mentioned earlier about what's happened differently. Lenders wanted to lower risk. How do we lower risk? And one way that we've lowered risk at my bank is we're not currently offering cash out refinancing or home equity lines. We put a pause on them. If somebody wants to encumber more debt against their home, that's a secure loan for the bank. And we elected to just put a pause on accepting those right now until things settle down and there's a better barometer of what to expect moving forward in the economy and, jobs. And equity lines. There's still a few lenders out there that are offering equity lines. We just made a financial decision to put a pause on those and reallocate the resources behind the processing and underwriting on those to help out with the other purchases and refinances that we were desperately needing additional resources to help move through the pipeline.
Yeah, and I can completely respect that, right? Again, large-scale organization like that saying, right now we're not going to try to do everything. We're not boiling the ocean, right? We're going to find the services and products that we have within our portfolio that we can be successful as an organization ourselves, and that we can help our clients and potential clients be successful. We're not going to try to do every single thing right now until some of these waves die down, which is good, right? And I can completely respect that. I don't think I need to do anything around this establishment for a while. I've already got the pool in, so I don't need to do a home equity line. So I don't know, maybe Daddy could use some new shoes down the road, but we'll think about that later. We won't do that on a 30-year fix. We'll do that on 15 years, something like that. Amen. Right. I've got some higher education dollars that need to be taken care of, and the majority of that is covered already. But we may need to talk about moving some more dollars and cents around. Chris, in closing, man, tell us again, just what you're doing from your organization. If you got one or two best practices that potential homeowners can keep in mind as they get ready to go through a process, especially now with all of the challenge of a pandemic, with all the challenges of just the state of events and state of affairs, if they're looking at moving into some type of a mortgage situation.
I would say be upfront with your mortgage professional. Be honest with them. Tell them what's going on behind the scenes. You know, folks sometimes, especially people who purchased homes before, they know they know the game per se a little bit, and sometimes they feel they're going to pull one over on us. And the last thing you want to do is not be full disclosure about your financial situation. You know, and this happens. Self-employed borrowers are the ones that are probably having the most challenging time. You know, when it comes to retractions and lending guidelines, if we're not really using rental income right now. Someone's got 3 or 4 rentals and they know their rental income's covering it, even though their tenants might be paying on time and have always paid on time. We're not currently using that income because we have no way to paper trail if that income is actually still current and relevant. You know, the tax returns are a year old. You know, and we're still working through how to manage that, you know, just because there's still a lot of clients who have well-paying jobs, still doing great, and everything's fine. They just happen to have a little too much rental income, and we're not able to use it, and it makes it challenging to budget them. But full disclosure is really important, because the last thing you want to do on especially someone buying a home, is to find out halfway through the process that, you know, something came up that wasn't disclosed, whether it comes from the credit report or a certain line item on a bank statement that now raises a red flag that opens up a whole nother can of worms that led to a discussion where the answer was, oh, that's what happened. Sorry, we can't do that now. And now you're putting people's time and money at risk. You know, when someone's buying a home, they have a deposit they've given to the escrow company, and there's a, you know, depending on the timing of everything, that could fall into the hands of the seller as a, you know, as the result of it. It's just utilize technology, be upfront with your mortgage person. Most mortgage people that I know are pretty flexible. You know, we play by the book. You know, sometimes things can stay with us. I mean, we don't have. It's just, you know, but share it with us so we know, because we have to be able to approach the transaction in a way where it can be. And people, you know, and you just don't want to go into it lackadaisical. You want to prepare technology, share everything you've got going up front, and be a little flexible. Right. This market's a little bit different. You know, lending, the institution I work with, we still really prioritize purchase loans in front of refinance loans. We're locking our interest rates for 90 days on a refinance. We're expecting to get it done within 60 days, but if that underwriter is in 30 days or less, then we want to make sure that they can dedicate their time and effort to those purchase loans, and they'll have to shelve that refinance for a couple of days before they can circle back and put more effort into it. Gotcha. Down payment helps, and let us know where it's coming from. You know, that's really big.
Have that paper trail, right? You know, the more down payment you can have, always the better. And if you got too big of a down payment, hey, where are you getting this liquid cash for the most part, right?
Someone's got a $50,000 deposit into the bank account, and where did it come from? Oh, it came from your Fidelity account. Great, give me the most recent statement for that. Oh, there's a $100,000 deposit into that Fidelity account 2 weeks prior. Where did that come from?
Yeah,
and it happens. And then it comes to find out it came from mom, you know, or it came from a good friend, or it came from a business that's going under. It all can come into play. There's still some down payment assistance programs. Cal Half is still plugging away.
Okay.
Programs that have kind of been put on pause just because, you know, the county down payment money is kind of based on a budget, their county budget, and those budgets are in limbo right now. So a lot of them have put a pause on offering them. But Cal Halfa is still a program where if someone just doesn't have any other way to acquire some down payment and money for closing fees, those programs are available.
Awesome. And those are the tools that I think everyone needs to adhere to, and those are the nuggets that hopefully some folks that are in the situation or getting ready to get into the industry and into the market will take advantage of. Mr.
Yes, sir.
Harris, I thank you, sir, for your time. I thank you for your knowledge. Good. It was definitely a good session. I hope you enjoyed it as well. And if there was, is there anything else particular that you wanted to talk about?
Uh, no, I think we covered it all. I mean, it's
Okay.
just, it's still a lot of people buying homes. There's still a lot of people refinancing. Rates are extremely low. I wouldn't wait for the grass being greener down the road. Get it now. In fact, if you jump into a refinance now, you don't have to worry about what happens if rates get lower 2 months into the process, because you at that lower rate. If it happens midstream, we're locking everything up front. We're
Gotcha.
not really encouraging people to gamble with whether rates are going to be better in the near future. We want them to be protected from it going up, and protected to allow it to, to take advantage of it if it goes down. So if you're having the conversation amongst your household about whether to do it, you're welcome to reach out. I'm happy to talk with you. I work all the time. I'm pretty
All the
readily
time.
available. I'm
I
pretty
know
readily
this.
available
I
at
know
8
this
o'clock.
all the time.
And
Yeah.
so,
Yeah. I have texted you at midnight, even after midnight, a few times, and you have, for some reason, responded right back. And I don't know, but that's pretty admirable, to be honest with you, man.
I appreciate it, man.
Thank you. Hey, Chris, appreciate your time. Thank you very much for blessing us with some of this information. Folks, again, I will put a lot of those links and some of those resources that Chris mentioned in the show notes on the site. And again, we thank you very much for joining us for another edition of ITN Live on Infotainment News. We out.
Appreciate you.